If you thought the Fed was about to cut rates, think again, because tonight, one decision just changed the entire market narrative. Segment 1, the headline, a tactical pause. FOMC statement overlay, Fed holds rates at 3.50% to 3.75%. Welcome back to Before the Bell. The Federal Reserve just wrapped up its high-stakes March 2026 meeting, and there's no pivot, no relief, no bailout for the markets. Fed Chair Jerome Powell and the FOMC voted 11-1 to hold interest rates steady at 3.50% to 3.75%. This marks the third straight meeting with no change, and one message is now crystal clear: higher for longer is back. But here's where things get interesting. We just got a weak February jobs report, 92,000 jobs lost. Normally, that would scream rate cuts incoming, but the Fed is ignoring it. Why? Because something much bigger just hit the system. Segment 2, the energy shock and inflation rewrite. The real story isn't the rate decision. It's hidden inside the Fed's summary of economic projections. The Fed just raised its 2026 inflation forecast to 2.7%, a 30 basis point jump in just 3 months. That's not normal. That's a warning. The reason? Oil. Brent crude has surged past $105 a barrel, driven by escalating geopolitical tensions in the Middle East, strikes on Iranian gas fields, retaliation hitting Qatari infrastructure. This isn't just volatility, it's a full-blown energy shock. And here's the key moment. Powell admitted this oil spike isn't even fully priced into the forecasts yet. Now layer that with ongoing tariffs, adding roughly 75 basis points to core inflation, and suddenly, the Fed's 2% target looks far away. In fact, they're now signaling we may not see price stability until 2028. Segment 3, the labor market paradox. Now let's talk about the labor market, because this is where things get strange. On paper, the Fed projects 4.4% unemployment. That sounds stable, but Powell's tone? Completely different. He described the labor market as sitting on a shaky foundation. Here's why. Private sector job growth? Basically zero. Labor force growth? Stagnant. Participation? Falling. So unemployment isn't rising, not because things are strong, but because fewer people are even in the system. It's a fragile balance, and the Fed is worried about something much worse. If energy costs keep rising, hiring could collapse non-linearly. In simple terms, the job market could fall off a cliff while inflation stays high. That's the nightmare scenario. That's stagflation. Segment 4, market reaction and the bigger picture. Markets did not like this. We saw an immediate hawkish repricing across the board. The 2-year Treasury yield jumped to 3.80%. The S&P 500 dropped 1.4%. And gold? It just broke below the critical $5,000 level. Why? Because the US dollar is surging on safe haven demand. This is the market waking up to a new reality. Rates are staying higher, inflation is staying sticky, and growth is getting weaker. Segment 5, the transition and what comes next. And here's the twist you cannot ignore. Kevin Warsh is set to take over as Fed chair in May. That adds a whole new layer of political pressure. The White House wants lower rates, the Fed is fighting inflation, and the economy is stuck in between. Right now, Powell is holding the line, but the margin for error? Extremely thin. The bottom line, this is no longer a normal cycle. The neutral rate is higher, the risks are asymmetric, and the path to a soft landing is getting narrower by the day. Stay diversified, watch oil closely, and don't underestimate this shift. This is Before the Bell. I'll see you in the next update.